Hey guys, Jared Wesley here of Live Traders and back for another weekly educational lesson. This week's topic I think applies to almost every trader out there, especially newer traders, even some experienced traders as well. What I've decided to do today, guys, is basically talk to a lot of the newer traders. And again, this does apply to some experienced traders as well, but I've been getting a lot of questions, especially from folks in the chat room, etc., about, hey, a lot of the things you talk about are high-level topics or bottoming tails and double bottom retest and things. Why don't you talk a little bit about what it takes, the process you need to go through to become a trader? So I thought, you know what, that's a good topic. So basically today's topic is learn day trading. That's the best title I could think about for it, guys, is that I'm going to talk to you and show you guys what is realistic, what you can expect through your trading journey, okay? Coming into the business, one of the things I've found is that most traders have failed before they've ever taken their first trade. Let me repeat that. Most traders have failed before they've ever taken their first trade. Why? Because they're so busy thinking about all the money they're going to make and forgetting about the process they have to go through. Everybody's got that outcome goal. Oh, I want a Ferrari. Oh, I want to make 200 grand a year, right? But they don't think about the process. So today I talk about the process, what you need to do to become a successful trader from start to finish. Now, obviously in 1 hour, guys, it's not going to be as complete as professional trading strategies, which is 18 hours. But what I'm getting at is we talk about why you need to build a trading plan, why you need to track your trades, why money management is important, why trade management is important, why level 2 and order entry is important. In terms of, we also talk about scanning and the need for gaps, as well as a trading plan that has all those criteria that you're scanning for with your gaps, as well as pre-market charts, guys, and just general expectations to become a great trader. You do not want to come into this business overhyped, undercapitalized, and with expectations that exceed your experience. Sadly, 98% of you guys are overhyped, undercapitalized, and you have expectations that exceed your experience level. It's a recipe for disaster. It's partially your fault and partially the internet's fault. The internet has you believing that $1,200 into $20,000 is normal. It's not. Okay, the internet has you believing things like, oh, you can do this in 32 seconds a day. No, the internet has you believing that you can be from 0 to successful in 3 months. No, those things are just not true, guys. And look, if you don't want to take my word for it, just go to those companies. They'll be happy to sell you a course and promise you riches in 28 days. I'm telling you the truth. So you definitely want to watch this video. I break it down step by step. I use a lot of charts. I say that because you guys love charts, but we talk a little bit about psychology, trade tracking spreadsheets, journaling, order entry, level 2, patterns, money management, trade management. I squeeze it all into 1 hour. Okay, so I hope you guys enjoy the video. I hope you learned something from it. And as always, you can get a $1 30-day trial to the Live Traders chat room by clicking on the link in the description. If you like this video, please click like and also subscribe. Guys, think about it. You get all these great video notifications every week by subscribing, all right? I'm Jared Wesley of Live Traders. Let's get to it. Don't be fooled by the title. The title says learn day trading, everything you know. So let me say this. I get a lot of emails from folks and a lot of comments from people. And one of the comments I get from people is, in the chat room specifically, you guys talk about a lot of topics, but you assume a lot of things, right? You assume a lot of things. And we do. Right? We assume you know what a red candlestick is or a green candlestick or what a bottoming tail is or what a limit order is and all that kind of stuff. Like, we make a lot of assumptions. So today I thought it would be a good idea to talk about trading. What is day trading? What is trading? It doesn't even have to be day trading. It could be swing trading. It could be core trading. We're going to talk about all of it. And it's a bit of a longer presentation, something like 30 or 40 slides. I probably could have made this 50 to 100 slides. So I'm going to basically go down I'm going to break it down today from when you're new to when you become experienced and everything in the middle. Basically, the process to become a good day trader, okay? Even that term, day trading, scares people off. It scares people off because most people, well, they trade like gamblers, right? We don't do that here. Everything has an entry, a stop, and a target. So we're going to talk about that today. So let's talk, as we just dig into this, okay? What is out there? What people are really thinking? You guys may have seen some of these on Google. I kind of made my own. There's a lot of them out there. It's like, this is what my family thinks I do, right? They think you're in your pajamas, you got your laptop on, and for some people that might be true, Unmol. But for most of it, this isn't really what it's about, right? Now I'll skip over to what what society thinks you do, what your friends think that you do. Well, this is what they think we do, right? Let's be honest about it. Most people think that trading is akin to gambling because most traders are gambling. So this is what society and most family and friends think you do. Oh, family might think this is what you do, right? But this is definitely a big mantra out there. Oh, be careful. Don't lose all your money, right? A lot of traders think this is what they do, right? Everybody wants to be Gordon Gekko. And a lot of people think, that's what the goal is. The goal is to be Gordon Gekko. No, that's not what we do as traders. And then this is what you actually do, right? You actually are sitting at a desk in front of 1, 2, 3, 4, 5 monitors. No, not in front of 57 monitors like you see on some Google shirts because people have big egos. But most of what we actually do is not terribly exciting. I'll repeat this, right? What most of us do is not terribly exciting. Somebody's making the comment the goal is to be the Wolf of Wall Street. No, that is absolutely unequivocally the opposite of what you want to be. The Wolf of Wall Street is a thief, a crook, a scam artist, okay? That's what most of Google advertisements are. Thievery, scamming, etc. You don't want to be. That's illegal. Unless you want to go to jail, that's cool with, if that's what you want to do. It's just not what I want to do, okay? But when you look at this, this is basically what the world thinks of us. Your family thinks you sit in your pajamas all day and TikTok around. Society thinks you're gambling. What you really think you're doing is trying to be Warren Buffett or Gordon Gekko. But the reality is good trading is quite frankly boring. You scan, you watch, you wait. You scan, you watch, you wait. And then maybe 1 minute out of 30, you actually are doing something towards getting into a stock. It's what a lot of Americans, I'm not saying this is true, so Europeans, please chill out. A lot of Americans think of soccer. It's like watching paint dry, and for that 10 seconds, they score a goal and the game's 1-0 or 2-1, right? But my point is, good trading is boring. So get all this other stuff out of your head. You're not Gordon Gekko. You're not a gambler. And you're not doing this from your pajamas in your bed with a laptop. None of these 3 things are true. This is true. You treat it like a business. You get up, you take your shower, you do your normal routine. You don't get out of bed 5 minutes before the market opens with sleepies in your eyes and barely making it down the steps or into your office and oh, what do I do? That's not how this works. Not if you want to be any good at it anyway. Okay, the other thing too, and I'm unfortunately adding to this mantra by showing the next slide. Okay, I'm adding to this mantra by showing the next slide. I don't really want to do it, but I'm going to do it anyway. Okay, this is what happens. Everybody sees this $2,100 into 50 grand. Goes, that's going to be me. That's going to be me. I'm broke. I don't have any money. I need to change my life around. I hate my boss. I hate my job. I'm going to do what he did. But what nobody's telling you is I risked 2 or 3% per trade to do this. And I had about 9 or 10 years of experience to do this. Okay. That's an experienced person risking too much. Not a novice person risking too much. That's just deadly. This is an experienced person who risks too much. And this problem is everybody sees it and goes, well, if it can be done, I want to do it. No, this is not how you're going to be successful in trading. So I'm just going to get off this slide because I don't want you guys to focus on it. Okay? So I want you guys to consider this as I go through this. And don't worry, it's not all text slides. There's quite a few charts because I know charts are what keep people interested. How misguided. It says closing comments, but it should really say beginning comments. Guys, realistic expectations are the key to this. Most traders fail. I want you to pay attention to this. Most traders fail before they've ever taken a trade. Most traders fail before they have ever taken a trade. Okay? Why? Because they come in with expectations that grossly exceed their experience. They're undercapitalized, overhyped, Okay, they don't realize how challenging this business is, and they don't realize within the confines of any business that making 50, 100, 200% returns in 1 year just doesn't happen in the normal world. But you think you're going to come in with no experience and make 1,000%. Please, right? Statistically, less than 8% of people in the US make 100 grand a year. Not families, that's individual income. Less than 8% make 100 grand a year. And that's in what? Traditional jobs that are already set up for success, right? That's management people, whether it be McDonald's, whether it be a construction company, whether it be Microsoft, less than 8%. But you guys are coming in going, no, I'm going to set the world on fire in 6 months. Be conservative when you plan. Use common sense. 10 to 20% returns every month are fantastic. The end of the year, that's 100 to 200% or more. You do that for 3 years in a row, oh my gosh, you're living the good life. You go to college for 4 years, you come out making 40 grand a year after you paid 100 to 200 grand to the school to learn absolutely nothing. Let's be honest, I went to college too. You don't really learn much in college. It's just the name on your diploma that they care about, right? It's the truth. Give this thing a fair shake, 1 to 3 years, okay? Now, I want you to consider, I went through some of this, but have you really, really, really thought this through? Okay? Have you? Are you properly capitalized to be a trader? Is this really a business to you, or is this just a hope or a dream that you're going to throw a couple grand at? Guys, if you only have a couple $1,000s to your name, you're not ready. I used this analogy in a video a couple weeks ago. Just because you pass a McDonald's and go, man, I really would love to own a McDonald's, doesn't mean you get to go own a McDonald's, does it? No, you have to go through the process of saving money, the interview process, hamburger, and guys, that saving money is like $1 million, $1.5 million. So just because you got 3 grand to your name and you want to be a trader, doesn't make you a trader. So do you have realistic expectations? Are you properly capitalized? Will you treat this like a real business, a proper business? Okay? One where you show up on time and you leave late. You work hard and you do the things in between you're supposed to do. No, most of you don't. If you had a boss in trading, most bosses would fire you. Let's be honest about it. Do you have a plan? Meaning, if you went to a bank to take out a loan to start a business, they would ask you for what? 20, 30, 40% down, and they would want to see your business model, your business plan. How are you going to accomplish these lofty goals that you keep talking about? And on top of that plan, what style of trading? You're going to be a swing trader, a core trader, a day trader, right? What type of trading? What kind of risk level are you going to have? $10, $100? Remember, new traders, $10. All right? What patterns are you going to trade? 3-bar plays, buy setups, parabolics. How are you going to find those patterns? Scanning, gaps. Have you learned order entry? How are you going to get filled on those great ideas that you find when you scan? How are you going to get filled? We talked about cyber today, right? We talked about scalping cyber under 120 today, and I told you guys, no way you will get filled if you put your order at $19.99 as a short play. You have to get in at 120.00 or 120.01. Guess what? As soon as it broke 120.00, it dropped 25 cents with 0 shares filled between 119.99 and 119.75. 0 shares. So great, you had an awesome pattern. So what? You couldn't get filled on it. It's meaningless if you can't get filled on it, right? So understanding spreads so you don't get hurt, share sizing appropriately, money management rules, trade management rules, understanding who's trading, personality traits, time constraints. Not everybody has 8 hours a day to trade. Follow-up, journaling, tracking your trades, reading books, talking to traders, taking courses. Heck, take a vacation when needed. These are the things you have to consider. Wait, before you ever take a trade. Put it down in a plan. But no, hey, you could open up an account for $2 grand. You could be a trader, but you're not really a trader. You're just a hacker. You're a wannabe with a huge dream and nothing realistic about it. It's just a pipe dream at that point. It will never come to reality. Okay? So, we talk about it. You need to understand basic candlesticks. I'm not going to get into this in detail, okay? But this is a green bar. Most people think green means bullish. That's not always true. Most people think red means bearish. That's not always true either. But this is the body of the bar, and these are the tails of the bar. Guess what? The whole bar matters. For some reason, people don't like to think that the tail of a bar matters. It does, because it's the total range of the bar. All right, but you need to understand what a bar means, all right, and that these bars form charts, and these charts form patterns, and it's those patterns that you're looking to take advantage of to become a good trader. Okay, so this is your basic bar, right? It opens at the bottom and closed at the top. How do I know it opened at the bottom and closed at the top? Because it's green. By definition, this bar has to be green because the close is higher than the open. Over here, this bar by definition has to be red because the open is lower than the close. It's that simple. But you need to learn that, okay? In terms of different types of bars, this is what they look like. Some bars have topping tails. Some bars have what we call a doji, which means a narrow body with a tail above it or a tail below it, okay? Some bars have bottoming tails. Some bars are just full solid bars, but they all have different meanings. Note, it says the buying pressure is increasing, which means bullish, and that's true, right? A topping tail compared to a bottoming tail, this is a lot more bullish than a topping tail. But where they happen on the chart is just as important as how the bar forms. I've done a lecture, guys, I've done a lecture where I spent 15 minutes just on this slide. I don't have that time today, but a bottoming tail, topping tail, all that's well and good in a vacuum. But if you don't look at where it's forming on the chart, it's meaningless. So what you'll notice here is to become a good trader, not only do you have to think about what you want to accomplish before you start, you have to learn what it is that you're actually doing. Why do we take a stock that has a bottoming tail after 3 or 4 red bars? Because that stock is likely to bounce. But the question is, why is it likely to bounce? It's likely to bounce because sellers were in control for 3 or 4 bars, and now the balance of power is shifting. How do we know this? Because the bottoming tail means what? This bar was red at one point in time. It was solid red at one point in time, and it's no longer solid red. It now has a bottoming tail, which means by definition, buyers stepped up. They kicked the sellers out. Commitment from the buyers is higher than commitment from the sellers. Stock should bounce. These are the things you need to learn, okay? So what does it look like on a chart? Looks like this, okay? So here's a stock that's in a downtrend. Lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. This stock is clearly in a downtrend. Selling pressure is very strong here, right? It went from 60-ish down to $22. And then finally it bounces. But you know what, guys? It's bounced many times before, right? It bounced once, so what? It bounced up here, so what? It bounced here, so what? It bounced here, so what? This is where you have to understand technical charts. For example, this stock is a little bit extended. It's far from the moving average. It bounces, great. But that's not an action event. It retests the prior pivot low and then continues to go higher and puts in this, what we call a W bottom. This is an early sign that the stock is potentially transitioning from a stage 4 downtrend back into a stage 2 uptrend. These are the nuances. These are the things that you have to understand as a trader. But here's the beauty of being a trader, okay? Some of you right now that are brand new out there are going, oh my gosh, this looks like NASA rocket science. It looks so damn hard. Well, there is a challenging aspect to this. You have to understand what a pattern is and how a pattern forms. I get all that. But here's the beauty of it. You only need price and you only need volume. You don't need 100 indicators. And every trade, as we'll see here a couple slides from now, has an entry, a stop, and a target. So you know what your risk is before, during, and after the trade. See, most long-term investors have no true idea what their actual exposure is. Why? Because they buy and they hold till infinity, and they hold till the bottom, till the bankrupts. It's the truth. Most average investors, including your parents, your friends, and your family, they just buy and they hold. When do they finally sell? When the pain is so great they can't take it anymore, they finally get out. Well, that's not a plan, is it? Letting your emotions dictate how you trade or invest is a terrible thing. You want what we call robotic indifference. So why does that make charts so special? It makes charts so special because when they give you a buy signal, we buy and we put a stop in and we have a target. If it doesn't work, we stop out. We know how much we're going to make if it works. We know how much we're going to make if it loses. And we just move on to the next trade. It's beautiful. It simplifies the approach so much. And by the way, guess what? It doesn't just have to be day trading. This is a weekly chart. A stock that you would have bought somewhere around $27 with a stop at 26 and it went up to 37, $10 move, 10 to 1 on your money. But guess what it took? Like 3 months. It's a core trade. So yes, you can apply this to your 401k. Yes, you can apply this to your IRA. Yes, you can apply this to your long-term investments. That's another beauty of trading. A 1-minute chart and a monthly chart are the same exact concept. One just happens, every bar is 1 minute, and in this case, every bar is 1 week. All time frames, all patterns are valid in all time frames. Isn't that a beautiful thing? In investing, you don't even know what you're doing. You're tongue-tied and twisted. You're pretzel-tied. Oh, well, Elon said it's a good company, so I think I'll buy Tesla. Really? Tesla's overvalued by probably 10 to 1 right now. How many years before Tesla catches up to its actual stock price valuation? 5, 10, 15? So you're sitting on dead money. Just follow the chart. The chart will tell you it's too extended. Okay? So let's move on. Guys, how do we take advantage of those patterns we talk about, right? How do we take advantage of candlesticks? Through patterns, right? 3-bar play, breakout, buy setups, wedges, triangles, turnaround plays, parabolics, much more. Guys, there's probably 10 more patterns out there. All right? That's how we take advantage. Now, why is this a beautiful thing? It's a beautiful thing because it takes the emotion out of it. There's a 3-bar play. We talk about these a lot. Wide bar, narrow bar, rip. Guess what? You buy here and you put your stop there. Don't overthink it. You buy here, you put your stop there. How do you know if it's a good 3-bar play? You have a checklist for that. The checklist tells you exactly what you need to know. And you go down and you go check, 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 check. And if enough of the boxes are checked off, you can take the trade. If not enough of the boxes are checked off, you can't take the trade. Simplify your approach. What are you all doing? Wide range bar, narrow range bar, blast off. Buy here, stop here, look for 2 to 1, move on next. Same with a buy setup. Get your pullback here, you're going to buy here, put your stop here. Targets 2 to 1 next. Why are you overcomplicating your trading? Why are you overcomplicating the business? It doesn't need to be this complicated. See, the problem that many of you guys are facing is you lack confidence, and that's normal in any new business. And when you lack confidence, what do? You search for it. And in searching for confidence, you become pretzel-tied, right? Tongue-tied and twisted. Why? Because this website says this indicator is the best. That website says Elliott wave theory is the best. This website says Fibonacci retracements are the key to riches and success. It's all bullshit. It's all garbage. You know what every one of those concepts has in common? Every one of them. You know what they have in common? These red and green candlesticks. They all base that theory off of a red and green candlestick. All those indicators you're searching for to help build your confidence because you think it's the holy grail, they're garbage. I even had somebody tell me, no, Jared, it's the MACD crossover. No, it's not. Okay, it's just candlesticks. Because the MACD crossover couldn't happen without candlesticks. All right, that's price. And then volume, why is that important? Because price tells us what is happening and the volume tells us how it is happening. Is it happening with commitment or a lack of commitment? Are there enough shares to trade on this stock? Right? So we take a look at these. They're simple. Wide bar, narrow bar, rip. You can erase the blue line if you want. You guys have to understand that what is most important are candlesticks, not indicators. Stop overcomplicating the process. You know why you do it? You lack confidence. Why do you lack confidence? Because you struggle when you're new. And you guys think for some reason struggling when you're new is not normal. Guess what? Newsflash. You struggle at everything you're new at. If you've never played golf and you went to the driving range, you'd shank a few balls. If you've never walked before in your life, you're going to trip a few times. All right? If you went and tried to play basketball with LeBron James and never played, he'd school you. Accept the fact that you're new and you will struggle and it's normal, it's okay, and it's acceptable. It's when you don't realize and appreciate that you start searching for things that are not important. Okay? Guys, keep it simple. You just saw the last slide. These are trades from this past couple weeks, past month. $1,000. Wide bar, narrow bar, rip. There's CRWD. Next. Here's another one. Wide bar, narrow bar, rip. This was a few days back. Another $800 or $900. Keep it simple. There are no moving averages on this chart. There are no moving averages on this chart. And this one only has a 200 on it. I don't use anything but candlesticks. Price and volume. Price and volume. Price and volume. Is it becoming more clear? Stop overcomplicating your trading. Now, you want to ask yourself, are you more suited to be an intraday trader? Are you more suited to be a long-term swing trader? Do you want to hold stocks for 3, 4, 5, 10, 12, 20 days at a time? You might. Why might you want to do that? Well, you might not like the high action of trading the first hour of the trading day. That might be too quick moving, too fast moving for you. That doesn't suit your personality style, which we'll talk about. Maybe you like that activity and you're good at pressing the button, meaning you're quick and you're accomplished, right, at picking a stock price, getting in and putting your stop in quickly. That's what an intraday trader would do. One happens to be income producing and the other one's wealth producing, wealth building. Ultimately, you should be doing both, ultimately. But when you start, choose one. Maybe your time doesn't allow you to be an intraday trader, so be a swing trader, okay? So you have to decide before you take your first trade. Am I going to be an intraday trader? Am I going to be a swing trader? Am I a longer term person? Am I a shorter term person? There's nothing wrong with either one. And ultimately, like I said, you probably should be doing both. Okay? Now, what are some of the things you might want to consider in making the decision to be an intraday trader or a swing trader? Well, think about your personality qualities. Think about your time constraints. Think about your capital restraints. Intangibles. What are you good at? Right? Are you really slow when it comes to scanning? Well, that might lead towards what? Swing trading. Okay? Personality-wise, are you really kind of a little bit nervous and jittery? Well, you might want to stick to intraday trading on micro time frames, 1 or 2 minute charts. What kind of time do you have available to you? Some of you guys, honestly, you're on the East Coast, or maybe it's 9, 10, 11 o'clock when the market opens in your country and you are already at work. Well, you probably need to be a swing trader. Some of you live on the West Coast in California or Hawaii. The market opens at 4 a.m., 6:30 a.m., etc. Guess what? You can intraday trade if you want, if you have another job. So consider these things before you make a decision. Notice I'm trying to lead you down the path to set up a proper trading plan, to give yourself a fair opportunity to succeed in this business. Okay? So again, this is examples of a day trade. Here's a 5-minute chart. Wide bar, narrow bar, drop. Over here is a 15-minute chart. This is a buy setup. This is what an intraday trade looks like. This is what another intraday trade looks like. But the difference is one is faster moving. 5-minute chart moves quicker. 15-minute chart requires more patience, and more patience requires more time. There's nothing wrong with it. Maybe you want to be an intraday trader, but you're not really quick with the trigger button. So you might want to trade 15-minute charts because they form in a slower manner, in a slower fashion, right? That's how they form. So it gives you more time to do your due diligence, to get through your checklist. Over here, you have to get through your checklist quicker. Things happen faster. But you're going to notice something on the next slide. It's going to fascinate you. Take a good hard look at this 5-minute chart. Take a good hard look at this 15-minute chart. Now watch. This is swing trading. It's the same damn thing. This is a wide range bar with a narrow range bar. Let's go back. This is a wide range bar with a narrow range bar and it dropped. It's a short play. Let's go back. This is a wide range bar with a narrow range bar. It's a Groundhog's Day in here. The only difference is it's a daily chart. The other one was a 5-minute chart. But what you're looking for doesn't change. This is a breakout. So instead of this being every bar is 5 minutes, every bar is 1 day. So this consolidation lasted for 2 or 3 weeks instead of 2 or 3 minutes or 20 or 30 minutes. Take a 0 off it, add a 0 to it. That's the difference between intraday trading and swing trading. See, many of you, I get this question so frequently. Hey, Jared, can you talk about swing trading sometime? You always talk about day trading. It's the same thing. There's nothing different. You use the same order types, the same patterns, the same entry points, the same stop losses. Sure, the stop loss will be wider on a swing trade, but it's still under bar number 2. Nothing's changed. There's no rocket science between intraday trading, swing trading. Things just happen quicker intraday and slower in swing trading. Now, nobody, or you can't, I should say, you can't call yourself a trader if you don't do this. If you don't have an entry, stop, and a target before you take the trade, if you don't have an entry, stop, target before, did I mention before you take the trade? You're not a trader, you're a gambler and a hacker, and you should give up right now. Harsh, aren't I? If you don't know what your risk exposure is before you take the trade and what your plan is, no matter what happens, you're a gambler. A good trader has a plan for any possible thing that happens. They get in here, they have a stop down here, and they have a target up here. And it's predetermined before they put their hard-earned money into it. Entries, guys, use stop limit orders. Stop limit orders for entry. Do not use stop market orders. I'll talk about it in a couple minutes. Stop losses, use a stop market order for a stop loss. Why? When you want to get out, you want to get out. Yeah, you might take a little slippage. That's part of the game. I don't want to hear about people running your stops and stops getting triggered. I don't want to hear about it. It's garbage. If you believe that, quit trading now because you don't have a chance. If you really believe that stops get ran that often, you don't have a chance because there's no way you're going to beat an HFT computer can place 1,200 trades in a nanosecond. Not exaggerating. Just stop now if you believe that. Okay? They don't stop hunt. And occasionally when they do, we got the 84% rule to get back in, don't we? We've got it covered. We've got it covered. Now take care of your business. Have an entry, stop, and a target on every single trade you take. If you don't, you're a gambler. No, there's no gray area here. It's cut and dry. It's black and white. You're a gambler if you don't have an entry, stop, and a target. That's it. Go somewhere else maybe. That'll lie to you and tell you that's not true. Targets, use a limit order. Okay? Now, break it down for you. Risk level. New traders should be risking about $10 a trade. I don't care when you're like, well, geez, Jared, I've been doing this for 2 years. If you're profitable, okay, you can go to $100. If you are not profitable after 1 or 2 years, you're still at $10. Yes, you heard me clearly. It's not a length of time. It's a level of profitability. Let me explain. It's not a length of time. That we have plenty of traders that are in a year and a half in and they're still losing money. If you're still losing money, guess what? It's better to lose less than it is to lose more. Risk less because you'll lose less. Oh my gosh, what a novel concept. Risk less to lose less. Oh my goodness. Imagine that. These people out there blowing up $50,000 accounts, stupidity. I know somebody that had a $1.5 million account and they lost $700,000 before the pain got great enough that they said, I can't do this. How the hell did you lose 700 grand? On $10 risk, that's kind of hard. Oh, that's right. They're better than you. They're better than me. Because, well, they had $1.5 million, so they think they're special. You're not special. You're not. New is new is new is new. I don't care who you are. Bill Gates, Jeff Bezos, Warren Buffett. Every one of those guys is new when they first start. True or false? If Jeff Bezos wanted to go learn how to play ping pong, does he have a chance against anybody in the top 100 in the world? No. So do you think it would be smart for him to bet $1,000 a game in ping pong? No, because he'd lose $1,000 a game. It'd be better for him to bet $10 a game, wouldn't it? Because he'd lose a lot less. Doesn't matter if you have it to lose, it's just dumb. Wealthy people aren't wealthy because they're dumb. They're wealthy because they're smart. Okay? And they're good with money management. Get it into your thick heads. If you are new and you are not making money, risk $10. I don't care if you saw somebody turn 500 into a gazillion in 47 days. I don't care. Okay? So let's get to it. 106.75 is the entry. Okay? Stop loss is 107.25. So your entry, this is a short play. We're hoping the stock goes lower. We're looking to make money when a stock goes down. I stress this because many people out there don't even realize that you can make money in a falling stock. Yes, you can. You borrow the shares at this price and you repay them back at a lower price. and the broker owes you the difference. Okay? So 106.75 is your entry. 107.25 is your stop. Remember, we need an entry, a stop, and a target. So this is a 50-cent stop loss, and we're looking for a $1 gain. Why? Because that's 2 to 1, and that's what I shoot for. You can shoot for 3 to 1, 4 to 1, 10 to 1. You can bar by bar it. There's a million ways to manage. That's a different topic. But know how you're going to manage before you get into the trade. So 50 cents. So we have a 50-cent stop loss. Okay, and we want to risk $10. We need 20 shares, right? If we short 20 shares of this stock and it doesn't work, we will lose $10, right? 20 shares and it goes and stops us out at 107.20, we'll lose $10. The position will cost you $2,135. If you have a retail leveraged account, most accounts are leveraged 4 to 1, the stock will require $533.75 in cash. In cash. Now, why am I putting the prices on here? Why am I doing this? Because quite frankly, I am sick and tired of people telling me that they can only trade penny stocks or they can only trade low price stocks because they have a small account. That's bullshit. This is a $100 stock and you only needed $533 to trade it. So don't tell me that ever again that you can only trade low price stocks because you have a small account. Guys, let's be honest. I hate to be the bearer of bad news, but if you have a small account, you ain't that good. You're not that good. Otherwise, your account wouldn't be small. Sorry, honesty hurts. Truth hurts. It's tough love. If you were that good, your account wouldn't be 2 or 3 grand. It'd be 20 or 30 grand. So clearly, you shouldn't really be risking more than $10 anyway, right? Oh my gosh, he's right, but I can't. My ego can't handle that, Jared. So I need to risk more. Go ahead, lose more money. It's up to you. Okay? So $533 for this. Now, you go up to a $100 risk. Now you need $5,000 to take this trade. That's not bad. If you have less than 5 grand, you probably shouldn't be trading anyway. If you want to do a $1,000 risk, now you need 53 grand. All right? $53,000 in cash. Now that's a lot of money. But guess what? By the time you get to a $1,000 risk, you should have at least that much money. Guess what? 1% is the most you can risk. So by definition, you'd have to have at least a $100,000 cash account to risk $1,000 on a trade, right? 1% of your cash account is the maximum that you're allowed to risk. So you should easily be able to take this trade if you're doing a $1,000 risk. New traders, unprofitable traders, should risk $10. Okay? And we do this by share sizing appropriately. We know what we're going to lose. Sure, we might lose a little extra in slippage. Okay? All right. I just went through this, so I'm not going to spend much time here. Guys, money management is everything in this business. Everything. You're going to struggle your first year in trading. You will. 100% you will struggle your first year. Okay? Even if you get lucky your first 2 or 3 months and do well, a pullback is coming. So don't get ahead of yourself. All right? So that means you really shouldn't be risking more than $10 or $20 a trade. I think $10 is the number. If you want to go as high as 20, whatever. Okay? But $10 is the number. If you break even in your first year of trading, you've done a great job. The only way you're going to succeed in this business is if you last in this business. If you don't last, you'll never succeed. Guess what? Guess what happens then? If you can't last after a year, okay, then clearly you were what? Clearly you were this. You were in this category. You were a gambler. If you don't have enough capital in your trading account, you either started with too little capital or you gambled the rest of your money away. That's it. It's the only possibility. You either started with too little, like $500 or $1,000, which you shouldn't do, or you gambled it away. Plain and simple. Okay? So, money management is your number one job. Controlling risk is your number one job. If you don't control risk, if you don't have money management, if you don't have an entry, stop, and a target, you're a gambler. Give up and move on to something else because the market will gladly take your money. Okay? Guys, we've been through this before. This is why you have stop losses. You can't predict the future. If you could, you wouldn't be listening to me and you wouldn't be here and you wouldn't want to be a trader. If you knew for sure, if you were Biff in Back to the Future, you wouldn't need this. This shit happens. It really does. I didn't color in this chart with a marker. This really happened. If you didn't take a stop loss, How are you feeling right now when a stock went from 20 to 9? You own CRVS long, and this thing tanked $10. Guess what? You've just become a long-term investor in a dead weight stock. You have dead money now for the rest of your life. You know who owns a lot of dead money? Every person on the planet who owns General Electric 10 years ago. No, maybe 10 years ago is a good time to own it. Let's call it 20 years ago. If you still own General Electric from 20 years ago, you're holding the bag. Dead money. You don't want to do that, because if you're a trader, you're a trader. You're not an investor. Your job is to get in here, get out right on that black line right there. Get in here, get out there. Don't hold the bag after it goes past your stop loss. That's dumb. That's gambling. And you know what the people I'm talking to? Many of you have done it before. You let a stock go past your stop loss, and you lost a boatload more money than you're supposed to. Instead of losing $10 on this trade, you lost 20, 30, 40, 50 bucks. You know what the beauty is about risking $10? Losing $100 don't hurt that much, does it? Imagine if you risked $1,000 on this, and let's just say you had a 50-cent stop loss. Let's just say you had a 50-cent stop loss, and this thing went $5 past your stop loss. You lost 10 grand on that. Instead of 1,000, you lost 10,000. That kind of hurts. If you risked $10, you might have lost $100. See the difference? I'm not saying don't take your stop losses. I'm just saying that if you did be an idiot, if you were an idiot and let this happen, at least you'd recover from losing 100 versus losing 10,000. Be smart, guys. Be smart. Okay? Use hard stops. No mental stops. I don't need to go through it. You guys have seen it before in a different lecture. This is what gambling looks like. I'm not even going to go over it. You can read it on your own time. That's just stupid. That's what dumb trading with no plan looks like. Okay. Now, quick, because I got to get through these slides in the next 15 minutes. Knowing what order type to use is really important, guys. And a lot of traders think, oh, I just buy here and sell there. If it were that simple, right? If it were that simple. Market orders, this is only to be used, guys, if something happens and you just got to get out of a trade. And in fact, I can't even really think of a great example to use a market order. There's never really a good reason to use a straight market order. Okay? Use limit orders for your targets. Limit orders for your targets. Use stop market orders for your stop losses. And use stop limit orders for your entries. A fill is not guaranteed with a stop limit order, but it allows you to determine how much you're willing to pay for a trade. Right? It allows you to say, do I want to pay 2 pennies for this trade? Do I want to pay 20 cents for this trade? Do I want to pay 30 cents for this trade? Okay? If you got in using a stop market order, you would pay what the market is willing to bear. So earlier I talked about cyber, right? If you put a stop market entry order at 119.99, you would have been filled at like 119.75. You would have gotten a 25-cent late fill. That's too much, right? It's too much. You can't control where you're going to get filled with a stop market order, but you can with a stop limit order. Okay, now, when we talk about protective stop losses, we use a stop market order. Why? Because the goal is to get out. Even if we have to pay a little bit much, even if we take slippage, you want to get out. The goal is to get out, right? Here, getting in, we don't want to overpay to get in. We want to pay just enough. All right, and Professional Trading Strategies talks in great detail. The order entry chapter is the largest chapter in the book. Why? Because it's probably the most important chapter, because it talks about money management, but it also talks about how you get filled on trades. Okay? So when you look at this, you have to use the right order for the right time. Okay? Yeah, I mean, somebody's commenting, they saw me get out of a trade using market when my platform froze. That would be about the only time I could think of. If your platform froze, maybe you just hit market and say, all right, I'm getting out and I'm not taking another trade until, the tech issues go away. All right? Now, why is level 2 important? It's everything, guys. Remember, if you can't get filled, you can't make money. The greatest pattern in the world is worthless if you don't get the shares you need. If you're trying to get 1,000 shares and you get filled for 100 shares, it's a worthless trade. Okay? So level 2 is important, guys, because it helps us understand where buyers and sellers are, what the spread of the stock is, which is where buyers and sellers are, okay? How whippy a stock is. The first 5, 10, 15 minutes a day, man, stocks are whippy. We saw a stock today, I think it was Shopify, SHOP. It had a $5 spread at one point. $5 spread. Could you imagine? So knowing the level 2, knowing where the buyers and sellers are, will help you get a better fill and not get skipped. Because now you know what needs to be done to get filled. You know what you need to pay and how much you need to pay up. And then you make a determination. I'm not willing to pay that much. I am willing to pay that much. But if you don't know, you're going to get skipped. All right? It also helps gauge our exit strategy. If there's a large block order near a target area, I might get out right under that block order. Okay? Also lets me know if the stock is really spready, maybe I should lower my share size by 5% or 10%. Why? Because if I stop out, I'm going to take nasty slippage, right? I'm going to get hammered for slippage. So this is a basic level 2. Most of you have a different level 2, guys. Okay? This is the kind I use on TradeStation. This isn't actually TradeStation, but it shows. I'm going to go over it briefly. The buyers are on the left in blue and the sellers are on the right in red. There's 16,600 shares on the bid on the buy side. And on the offer over here, the ask, there's 279,000 shares. So there's a lot more sellers here than buyers. So when this balance of power changes and this becomes 20,000 buyers and 10,000 sellers, that means the stock is likely to go higher. But right now, the stock is likely going to be fighting 1550 for a while until most of these sellers have sold their shares. Knowing this is important. It's important because once it finally breaks 1550, you might not get filled up here. Or if you get filled, you might get filled really late. Because usually it's like a dam, right? Once you're holding that water in so tight, when they finally crack the dam, these things rip. And that's what happens after you get rid of a big block order. You ever notice that in a stock? There's a big block order holding a stock down, holding a stock down. And when that block order is gone, they rip. Okay? Guys, I'm purposely not getting into super great detail here. Purposely. I can't do all this in an hour. I can't put an 18-hour course into 1 hour. Okay? Note here, buyers are at 55.89. Sellers are at 56. This is what we call the spread. It's an 11-cent spread. The spread is the difference between buyers and sellers. Okay? So over here we have 5,700 buyers to 53,000 sellers. The buyers are unwilling to pay more and the sellers are unwilling to sell cheaper. So what do we have? If you want to buy this stock right now immediately, you got to pay 56 for it. If you want to sell the shares, if you own shares and you want to sell them, and you want to do it now, you have to sell them at 55.89. That's if you hit market. If you hit market to sell, you'll get filled at 55.89. If you want to buy the stock and you hit market to buy, you'll get filled at 56. You're going to pay the spread. If you wait, though, you might get filled in this range if you offer out your shares. Why? Because some of these buyers might step up to 55.95 real briefly and come right back down. And if your shares are sitting there, they'll fill them. Okay? So over here, note, the spread has tightened. Note, it was 11 cents. Now it's 1 cent. Same stock, same stock. Notice the buyers are stronger now. 5,000 shares versus 16,000. Note the sellers used to have 53,000. Now they have 27,000. This is a stock where buyers are showing more commitment than sellers. Buyers are willing to pay up for this stock. That is commitment. So yes, volume matters. Level 2 matters. Okay? Here's a great example of what we talked about on Cyber today. Guys, under 177. Now remember, this is a 2-minute 3-bar play. Take a look at it. You guys are, oh my gosh, that's an amazing 3-bar play. You didn't get filled on it though, did you? Your order is supposed to be at 177.49, short. And your stop's at like 179, $1.50 stop. And this thing just tanked. It just dropped. It printed 900 total shares in a 32-cent range. 900 total shares in a 32-cent range. Does level 2 matter? Yes, it does. You would have gotten skipped. And this stock went down $1.50, $2 in about 1 minute. Guys, 1 minute, it went from 177.50 to 176.14. 1 minute. And you got nothing. So as beautiful as this awesome 3-bar play looks, you're sitting there twiddling your thumbs. So what's the alternative? Get in at 50 or 51 or 52 right here. It's the alternative. Okay? So things to consider. The volume of the stock, The price of the stock. Light volume stocks are harder to get filled on. Higher priced stocks are harder to get filled on. Why? Because they are spreadier. Higher priced stocks, except for those one-trick pony biotech penny stocks that are like $2 and have a 12-cent spread, most of the time the price of a stock also determines the spread of the stock. Okay? So you have to know, is it a high, thick volume stock like MU, AMD, Microsoft, or is it a thin stock like, I don't know, I can't think of one off the top of my head, maybe TAP or ALB or something like that. Okay? Price matters. The spread matters. The size of your stop loss, your risk to reward matters. You don't want to pay too much. It might hurt your risk to reward. If you have a 50-cent stop and a $1 target, and you get filled 25 cents late, guess what? You now have a 75-cent stop and a $1.50 target or higher. I don't want to pay up 25 cents. Got to figure something out. Maybe anticipate, maybe get in a little sooner. Okay? How many shares you need is very important. If you're a new trader doing $10 risk and you need 25 shares, not so bad. If you're doing $3,000 risk and you need 10,000 shares, that's different. You might have to work that order. You might have to start your order earlier. How badly you want to get filled is also a factor. If you just absolutely love this position and you feel confident it's just going to kill it, maybe you're willing to pay a little more. Not a lot more, a little bit more. So maybe I'm willing to give a trade 10 cents of room to get in. 10-cent stop limit order. But I really like it. I might give it 12 or 13 cents because I really like it. Guys, these are considerations. Very important consideration. In professional trading strategies, every one of these bullet points has 2 or 3 pages attached to it. So you can see 6 times there's about 18 pages just to go over these. All right. Scanning. How are we going to find these things? Well, one, you have to understand what a gap is. What a nice gap is anyway. Okay. So we're going to scan for them. And I'm going to use dollar gainers and dollar losers to do my scanning. Guys, it's sorted in dollars, gainers and losers. People are like, well, how do you sort that scan? No, it's just sorted in dollars. No, 185 is on top, 117 is on the bottom. They're sorted in order of the biggest price movers, not in percentage movers, price movers. So VBLT, there's the gap over that little consolidation. That's an interesting stock. I might put it on my watch list. Okay, I'm just going to use gainers and losers. All right. I'm looking for what I would call compelling gaps. We rate our gaps level 1, level 2, level 3. It depends on the shock value, where it's gapping from, where it's gapping to, relative strength, how much volume it has, etc. Okay, I'm not here to go into all of that. I'm here to show you what we do. So wide range red bar going lower. Well, this stock had a lot of selling pressure yesterday. You wake up this morning. Let's say you shorted this stock yesterday at 27.50. Hypothetical. You shorted at 27.50 yesterday. It closes at 27. You're feeling really good about yourself, thinking, you know what? We have room down to 23 bucks. This is great. You wake up today, it opens at 30. Remember, you own it at 27.50 short. You're 250 out of the money. Ouch. What are you going to do? You're going to buy to cover. You're going to get out of your short play, and to get out, you have to buy. To buy pushes the stock even higher. I want to be in this. So I'm looking for these types of gaps on this type of scan. Dollar gainers and dollar losers. That's it. Pre-market, I'm scanning the daily and the 60. That's all I'm looking. I'm not even looking at the 5-minute, 2-minute. I'm looking at the daily and the 60 in the pre-market. And I'm looking for really nice gaps. If a stock has a really nice gap, then guess what I do to it? I put it on my thumbnail watch list. All right? On 2-minute charts, and I watch it. And I stare at it. You can see right here. I put this out there in the chat room. I put it out there on StockTwits every day. Scoutmaster is my handle. And these are my long watches. Then I put a favorites list. So I do a long watch list and a short watch list. And then right before the market opens, I do a what? A favorites list. Why? Because I don't want to have to look at like 15 or 20 ideas. Yes, they'll be on my thumbnails, but I really want to dwindle it down to the best of the best and focus on those. So in this case, there's 5 favorites. Some long, some short. I stare at them. And guess what I do? I stare at them until they give me a pattern. And that's it. It's that simple. Stare at it until it gives me a pattern. Okay? So it looks like this. There's the gap. There's the 5-minute 3-bar play. There's the 2-minute, and that's it. I will have this stock, LL, wait for it, over here on my thumbnail watch list, and I will stare at LL. I will stare at LL until what happens? It forms a pattern on the 2 or the 5 minute chart, and then I will take it at 17 with a stop at 1675 and make bank. That's it. Simple process. Now, let's move on from that to scanning. Or sorry, did I say scanning? To tracking. Guys, if you're going to treat this like a real business, not a bullshit business, not a hacking thing, you're going to need to track your trades. You're going to need to either go out there and buy a tracking spreadsheet or make one. I made this particular one, okay? I'm not going to go into huge detail on this, but you need the basics. You need, is it a long trade? Is it a short trade? What's the entry? What's the stop? What's the exit price? Okay? How much did you risk on it? What was your profit? What was your loss? You need those things. You know what you also could really benefit from? You could also benefit from knowing extra information like, are you better on long trades? Are you better on short trades? Are you better on 1 minute charts? Are you better on 15 minute charts? Are you better on breakouts? Are you better on 3-bar plays? Are you better on Monday? Are you better on Thursday? All of these things do what? They help you fine tune your trading so ultimately you can be a better trader. If you're not tracking your trades, you're a hacker. Why does every big business track all their sales and cost acquisition per customer? What the lifetime value of a customer is? Why do they do that? So they can better market to their clients, ultimately being more efficient, and then what? Making more money for their business. How do you guys call yourself traders without using a tracking spreadsheet? How do you call yourself a trader without doing that? You're not a business owner. You're a hacker. Your boss wouldn't let you get away with it. Why do you let yourself get away with it? Okay? Think about that. Would my boss fire me? Okay? Post-market routine, record keeping. Take screenshots of all your trades. Review them. Were they good trades? Were they bad trades? Okay? Write down your emotions that you recall during the trade, after the trade. Okay? I'm not going to go into this in great detail. I got to get through a few slides here quickly, I should say. Okay? You have to have a plan. You have to have a tracking spreadsheet. You have to have a trading journal, and you need to, every day after the market closes or when you have time, maybe it's in the middle of the market day, write all that stuff down. If every other sports team does it and every other business does it, why don't you do it? You know why you guys struggle so much, guys? Because you have no oversight. You remember the quote I gave you guys a couple days ago? People will do what is inspected, not what is expected. People will do what is inspected, not what's expected. You don't have a boss in this business, so you have nobody to keep you on the straight and narrow. So what do? Whatever you want to do. And most of the time, people are terrible self-managers because most of you have never had to self-manage before, not to this level, not in a business that preys on your core beliefs and emotions. Track your trades, measure them. A bad month doesn't mean your trading plan is bad. I want to repeat this. One bad month doesn't make your trading plan bad, assuming you followed it. Okay? Trading plans only work when they're followed, guys. And you can only measure them when they're followed. If you don't follow the plan, it's hard to measure the plan. Okay? Remember, nothing happens in 1 week or 1 month. You need to do this over 3, 6, 9, 12 months to get meaningful results. And I just want to throw this back in there. Get this out of your head. This is experienced 8, 10, 11-year trader doing this. $2,000 is not enough. $3,000 is not enough. $13,000 is barely enough. Get it out of your head. New traders can't do this, so stop thinking you can. New traders cannot do this. Stop thinking you can. If you believe that, go to one of those penny stock gurus out there that'll steal your money from you. If that's what you want, go do it. Because people in life seem to love people that agree with them. When somebody agrees with you, it's amazing how their tune changes. They become nicer, they become more chatty with you, and when you disagree with them, they become confrontational, don't they? I'm just telling you the truth. I don't care if you like it or not. I'm just telling you the truth. So, a couple more slides. We're almost done here, guys. You have to have a realistic timeline. If you're not going to give this 1 to 3 years, don't start. If you're not going to give it 1 to 3 years, preferably 2 to 3, do not start. If you don't have at least $5,000 or $10,000, do not start. You're not better than somebody else, or you're not more prepared because of prior success. Jeff Bezos doesn't have an edge on you in trading. Bill Gates doesn't have an edge on you in trading. Michael Jordan doesn't have an edge on you in trading. Why? Because none of those three people have ever traded before, to my knowledge. So they're not better than you. If you were a trash collector, you're just as prepared as somebody who's a CEO. You're just as prepared if you have a trading plan and you follow it. Profitability will not come quickly. It will come very slowly and in the beginning at very, very small levels. Okay? If you need to keep a second job or a full-time job to make your dream work, then do that. Never be embarrassed by what you have to do to achieve your dreams in life. What you do with your time, whether you work at Circle K or Walmart, is nobody else's freaking business. Why do you care what your friends think about you? It doesn't matter. If you have a dream and you're going about it properly, right? Realistically, not with some, I'm going to turn $12 into 12 million. If you're going about it realistically, do whatever it takes to meet those goals, those dreams, those hopes. Do whatever it takes. If you got to take a night shift at 7-Eleven, do it. It's your dream. It's not your neighbor's dream. Who cares what your neighbor thinks about it? Their BMW is probably leased anyway and they're over leveraged. Who cares what they think about it? Okay? Expect ups and downs. It's going to happen. Inconsistency is normal in the beginning. I get that email all the time. Jared, I just had 2 really good months, but I started this month terribly. What's wrong? What am I doing? Maybe it's just a bad month in the market. Maybe you are doing things wrong. Don't jump ship because you had 1 bad month. Don't think you're great because you've had 2 good months. You will feel extreme highs and lows. I remember my weekend, sadly, when I first started, was highly dependent on how my trading week went. If I had a good week, I had a great weekend. I was happy, bouncing all up and down. If I had a bad week in trading, I was like half depressed all weekend. Don't let that bug you. That's just the way it is in this business. Stay away from that. Stay even-keeled. And then understand, guys, what's required. This business is no joke. Hardest thing you'll ever do, man. Outside of being in the military, it's the hardest thing you'll ever do. Hard work, dedication, persistence, continual education, market experience. You need every bit of every one of those things. And then some. All right? And then some. Okay? Last, one more slide after, but this is really the last thing I really want to truthfully comment on. So many people in this business, and I've used this slide before, you may have seen it. So many people in this business and in life, they have outcome goals. Everybody wants to be Kim Kardashian. Everybody wants to be Brad Pitt. Everybody wants to be Warren Buffett. That's great. That's wonderful. Okay? How are you going to do it? That's the process. Outcome, we all have outcome goals. A 16-year-old kid has a picture of a Ferrari on his wall. That's his outcome goal. I want to own a Ferrari someday. The question becomes how? How are you going to get there? Remember, outcome goals without process goals are just pipe dreams. So many people have this. How do I know they have this? Because they come in with $1,200 accounts, $2,000 accounts with no prior experience, no education, barely enough to open a trading account, and they want to make $100,000 their first year. Now I know they don't have a process goal, because if they did, they'd realize that's an unrealistic process goal, an unrealistic outcome for such a short period of time. Please, guys, I'm telling you straight. The vast majority of you have failed before you ever took your first trade because you came in with unrealistic expectations that grossly exceeded your experience because you were overhyped by some Google advertisement. Okay? I'm just telling you flat. If you want to be good at this, treat it like you would treat any other business. Treat it like it's your life savings, and if you lose it, you have to file personal bankruptcy. Treat it like that. Treat it like you put 80 hours a week into it. Treat it like that. You'll have a really good chance of succeeding. This business is challenging, and it should be. You get to do it from anywhere in the world from a laptop. So it should be challenging because the freedom and flexibility that it provides. Right? So anyway, outcome goal without a process goal is a pipe dream. Have a process goal. And that's what I'm hoping I gave you a little bit of a glimpse at today. The process to be a great trader. Yeah, there's a lot of things I didn't talk about today because I would be here 12 hours. But the process to be a great trader starts with a proper plan before you start. Proper capitalization. right? It also starts with tracking all your trades, understanding what good money management is, having a reasonable timeline. And when you do all those things, this stuff becomes, I don't want to say easy, but normal, right? Trading will never be easy. This week has been challenging, for example. Last week, I will call it easy. This week, challenging. But this stuff will become normal. You won't question things. You'll just do it. Okay? So my goal today was to speak to some of the newer traders, even to some of the experienced traders that maybe don't quite get it yet. You think you're there, but you're still risking too much, or maybe you're not tracking your trades, or maybe you're not understanding that your trading plan has to match your personality style. You can't just build a plan and think you're going to follow it. You have to understand what's required with personality traits, time constraints, capital constraints, right? And then you can go about building a proper plan. So I guess it applies to experienced traders as well. You can always be better. But to the newer traders, I get a lot of questions. Oh, you guys talk about such high-level stuff in the chat room. Well, this is a good lesson to learn, a good process to go through to be a good trader. And guess what? The market doesn't care what you need. The market doesn't care that you need to make money tomorrow because you want to pay your bills. It doesn't matter. You're going to go through the lengthy challenge and process from day one to year 2 to year 3 to be successful. You will not be better than somebody else. You will not cut corners, I promise you. You won't do it. You're going to have to go through the mud to come out on the other side. Shawshank Redemption at the end. That's what it's like. Seriously, that's probably a good movie analogy. That's what trading is really like. You're going to swim through the filth and the crap, and you'll still be a little dirty when you come out on the other side, but you'll clean up nice. All right? So that'll do it for this week's lecture. I hope you guys enjoyed that. I hope you learned a little something from it. It's a little longer than normal, but again, I hope it was helpful. To get more great educational content, subscribe to the Live Traders YouTube channel. This way you'll get email alerts every time I upload a new video.